Hello, friends, and welcome to this month's Palm Beach Confidential update. Today I'm in another hotel room. I'm actually down in Miami meeting with some of my colleagues to discuss some different ideas, research ideas, which is always great. I work with really just a phenomenal group of very smart people, and it's always wonderful when you can come together and share different ideas. So let's talk a little bit about crypto. I've been very active filming videos and sending them to you to give you not only a historical perspective on where we are and the cyclicality of this asset class versus other new emerging asset classes such as the internet stocks in the mid 90s. But I've also shared with you yesterday a pretty long video showing you the different proof of how institutions are preparing themselves to come into this market. And it's almost every day we're seeing more and more data that is validating this transition from a market that is driven by individuals to a market that ultimately, whether we like it or not, will be driven by institutions. Just today there was an announcement that a vice president over at Goldman Sachs has left, and this was the guy that was going to be setting up the trading desk for Goldman for Bitcoin. And he's actually left, and he's joined Mike Novogratz, who is also a billionaire and also a Goldman Sachs alum. He spent 11 years at Goldman Sachs. So, why is that compelling? It's compelling because if you're a VP at Goldman, you're making a seven-figure annual income. You have enormous job security, right? I mean, to be a VP, you've got to be very good at what you do. You're making a ton of money. And so to make that leap, it's a huge, huge, huge step. And then to make that leap when the market has declined as much as it has, again, it's part of that preponderance of evidence that I talked to you about yesterday. When you see smart people, smart managers of money move into a market, especially when they're moving into that market, when that market is out of favor with the broad public, it's incredibly bullish. It's really identical to what I saw between 94 and 95, when nobody in the general public wanted to touch a technology stock, but at the same time, we saw VC investments actually ratchet up, right? They eclipsed the investments that we had seen in the previous year. So between 94 and 95, we were seeing bigger investments than we had seen in the previous annual period. And we were seeing that as the average tech stock was down 50%. Many were down much more, right? 70, 80%. Big, huge names that we know of today. A lot of people, for the last 2 years, the number one question I get is it too late? Is it too late? Is it too late? And I want to assure you that it's not too late, right? This market is just beginning to percolate. So again, I will draw the parallel to tech. Tech really started taking off in the early 80s, around 84, 85, when tech started taking off. And then, in 1990, when we had our first really big tech sell-off, when you saw the NASDAQ drop about 40%, and that was when Oracle dropped 80%, the narrative that people were afraid of, the fear was, this whole tech thing was interesting in the 80s, but it's over. And then, we went through the same thing in 94, 95, right? So this is now, the tech boom was going 10 years strong from the early 80s to now 94, 95. And everyone was convinced, oh, this is it. Tech is over. We've invented everything we're going to invent. The internet, yeah, it's intellectually interesting, but you can't do anything with it. Everything's too slow. So many of the same arguments that are used against blockchain and used against Bitcoin, we're seeing now, right? I mean, I remember reading articles that were just, making fun of the internet, because back then it couldn't do much. Most of the pages were people talking about their cats. Even on television, people were saying, oh, what's this internet thing? It sounds pretty dumb to me. So this is a normal progression that you see in technology. And so what you want to do is you want to stand pat during that period of time, especially when the market is so small and the entire cryptocurrency market it's tiny, guys. It's $260 billion. We're talking about the same size as the amount of cash on Apple's balance sheet. right? I mean, it's just absolutely tiny. And if you want to draw a parallel to the NASDAQ, it's about the equivalent of where the NASDAQ was in 1973. Guys, 1973. On an inflation adjusted basis, that's where the cryptocurrency market is right now. So, yeah, a lot more upside. We're going to be patient. Just let the market go through its cycle. Now, I've got a couple of questions here that I've answered several times, but I'll definitely re-answer them. So one question is, why do I not use stop losses? So there's two ways to manage your risk when you're involved in any asset, any security or free trading asset, right? So one is you use a stop loss. It hits a certain point, you get out of the trade. You can't use stop losses on assets that are as volatile as cryptocurrency because you end up getting shaken out of them. So a prime example would be Ethereum, which we recommended originally around $9. It went to 20 and then dropped as low as $5 to $6, right? And then subsequently went to over 1,400. So if you use the stop loss, you're definitely getting stopped out of that trade. Or Monero, right, which at one point dropped 85% from the high to the low. It went from somewhere around $15 down to like 3 and change, somewhere in there. And if you were using a stop loss, you definitely would have been out of it. And then a year later, it went to 360. So this is the reason why I do not use stop losses in cryptocurrency. You can't. So what I do instead is I say, look, because the gains from this level are going to be so large, because this market is so small, we can use an equal dollar amount across the portfolio for each idea, and that basically becomes our risk capital, right? And we don't need to risk a lot. I say if you're a small player, put $200 to $400 in per idea. If you're a bigger player, put $500 to $1,000 per idea. Now, that method works now because the market is small. That method won't work in a few years when the market is a multi-trillion-dollar market. The same way that that method worked in the 90s for technology stocks and for internet stocks, because the market caps were tiny. You can't use that now in technology stocks and internet stocks. $200 or $400 a trade, or even $1,000 a trade, is not going to do anything for you, right? Even if you own Facebook, you own Google, right? It's just not going to do enough for you. So this is a unique opportunity that we have in history, at this time in history, because the market is so small. And what we want to do is we want to take this portfolio approach that we're doing, even out our risk across the portfolio, risk no more than we're prepared to lose. And that's our secret sauce. That's what gives us the staying power to live through a time like now, to live through a time that we went through in September, to live through a time that we went through in June, to live through a time that we went through in January of 2017 when the Ethereum network was getting hammered every single day, to live through a time that we dealt with a year and a half, 2 years ago, when one of the lead developers for Bitcoin sold all his Bitcoin and left. And we watched Bitcoin drop from 450 down to around 385. Okay, so again, the fundamental asset is inherently volatile. And so what we want to do, and really what my mission is here, is to harness that volatility to work for your wealth creation. And that's what we do by using uniform position sizes that are small. Now, the other question I've been getting quite regularly lately is, if a coin is below our buy up to and you don't own it, should you own it? Yes, absolutely. This is the great opportunity that we have now. For many months, a lot of the coins we couldn't own because they were way above their buy up to. Now, since we're in the middle of this pullback, many of the coins are buyable. So think about it. Back in 1994, the entire NASDAQ market was running and gunning, and you said, oh, you know what, this market's overextended. A lot of these stocks are now above my buy up to, assuming that I had a newsletter then, which of course I didn't. And then all of a sudden, the whole market crashes, which is exactly what happened between 94 and 95. All of a sudden, all these great names like Cisco, Microsoft, IBM, Oracle, right? All these great names that you couldn't buy before because they were above the buy up to are now languishing. They've been cut in half or worse. So that's the situation that we're in right now in the cryptocurrency market. And so I want you to think in that parallel, because that the similarities between where we are now and where we were between 94 and 95 are just, I mean, they're mirror images of each other, right? New technology, blockchain, new technology, internet, new technology, blockchain. People are starting to get aware of it. Still not 100% sure of what it is. 94, 95, people are aware of the internet, still not really sure what it is. Big sell-off 94, 95, big sell-off 2018. 94, 95, institutions start coming in and actually start pouring real money into it. 2018, we start seeing institutional money sniffing around the same asset. So it's rare in your life when you get the opportunity to have a do-over that can absolutely transform your financial life. And we have that opportunity now. My sincere hope is that you're taking advantage of it. You're being rational. You're using position sizes that make sense, that adhere to the methodology that I talk to you about pretty much every week. All right, so that is about that. Nothing more new to talk about here. Of course, as new things emerge, I'll be in front of the camera or doing a video, sending it out to you and communicating it to you. As I said in one of my previous videos, today is April 10th. We're probably going to continue to see some selling until April 17th, which is the tax day here in the United States. We think once that's over and then we start moving into May, and most importantly, the consensus event, which is going to be taking place in May, it's going to get exciting. It's going to get really exciting because in May is when I think you will see a ton of announcements of institutions coming into the space, institutional custody getting addressed. These are the really big issues that need to be solved, which will be solved, that are going to drive prices much, much higher. And of course, Bitcoin ETF, it's going to happen this year, and it's going to be dramatically bullish, not just for Bitcoin, but for the entire ecosystem. All right, friends, that is enough out of me. It is great catching up with you. As always, if you have any questions, comments, and concerns, please email us. Of course, we can't give you personalized investment advice, but we will do all that we can to answer your questions. And that is it. Just one last thing to say. I want you to always remember, let the gain come to you.